Market structure is the foundation of technical analysis in trading. It provides a framework for understanding price movements. By analyzing market structure, traders can identify trends, support and resistance levels, and potential trading opportunities. The building blocks of market structure are swing highs and swing lows. These points on a price chart represent temporary shifts in supply and demand. Swing highs and swing lows are crucial in determining the direction of the market. They help traders visualize whether the market is in an uptrend, a downtrend, or a sideways movement. Recognizing these patterns allows traders to make informed decisions about entry and exit points. Understanding market structure requires a grasp of these fundamental concepts. Traders need to be able to identify swing highs and lows accurately on a price chart. This understanding forms the basis for more advanced technical analysis techniques. By mastering the principles of market structure, traders can improve their trading strategies and increase their chances of success. A swing high is a peak on a price chart where the price reaches a temporary high before reversing and moving lower. It represents a point where buying pressure weakens and selling pressure takes over. Identifying swing highs is crucial for understanding market trends and potential resistance levels. To identify a swing high, look for a candlestick pattern where a candle has a higher high than the candles on either side of it. This indicates that the price attempted to move higher but was rejected, leading to a reversal. Swing highs are important because they often act as resistance levels. When the price approaches a previous swing high, it may encounter selling pressure as traders who bought at the previous high may look to exit their positions. Traders often use swing highs to draw trend lines. By connecting a series of lower swing highs, a downtrend line can be established. Conversely, connecting a series of higher swing highs forms an uptrend line. These trend lines provide valuable insights into the overall direction of the market. There are different types of swings, such as the three-candle swing high, where the middle candle has a higher high than the candles on either side. Another type is the five-candle swing high, which involves a middle candle with a higher high than the two candles before and after it. In contrast to swing highs, swing lows represent valleys on a price chart. They occur when the price reaches a temporary low before reversing and moving higher. Swing lows indicate points where selling pressure subsides and buying pressure re-emerges. Identifying swing lows is crucial for understanding market trends and potential support levels. Similar to swing highs, look for a candlestick pattern where a candle has a lower low than the candles on either side of it. This signifies that the price attempted to move lower but found support, leading to a reversal. Swing lows act as support levels. When the price approaches a previous swing low, it may encounter buying pressure as traders who sold at the previous low may look to re-enter the market. Just like swing highs, traders use swing lows to draw trend lines. By connecting a series of higher swing lows, an uptrend line can be drawn. Conversely, connecting a series of lower swing lows forms a downtrend line. These trend lines provide valuable insights into the overall direction of the market. Swing highs and lows are essential for identifying and understanding market trends. By analyzing the patterns formed by these swings, traders can determine the direction and strength of the prevailing trend. In an uptrend, the price makes higher highs and higher lows. Each swing high is higher than the previous swing high, and each swing low is higher than the previous swing low. This indicates that buyers are in control, pushing the price upward. Conversely, in a downtrend, the price makes lower lows and lower highs. Each swing low is lower than the previous swing low, and each swing high is lower than the previous swing high. This signifies that sellers are in control, pushing the price downward. In a sideways or ranging market, the price oscillates between a support level formed by swing lows and a resistance level formed by swing highs. The market lacks a clear direction, and the price moves within this defined range. Understanding these patterns is crucial for traders to make informed trading decisions. By identifying the prevailing trend, traders can adapt their strategies accordingly and improve their chances of success. Section 5. Swing failure, a telltale sign of market shifts. A swing failure, also known as a shift in market structure or SMS, is a significant event in technical analysis. It occurs when the price fails to create a new swing high in an uptrend or a new swing low in a downtrend. This failure signals a potential reversal or correction in the market. In an uptrend, a swing failure happens when the price breaks below the previous swing low after failing to create a new swing high. This indicates that the buying pressure is weakening and a potential reversal to the downside is imminent. Conversely, in a downtrend, a swing failure occurs when the price breaks above the previous swing high after failing to create a new swing low. This suggests that the selling pressure is subsiding and a potential reversal to the upside is on the horizon. Swing failures are crucial because they often mark a shift in market sentiment. They can be early warning signs of trend reversals or significant corrections. Traders pay close attention to these failures as they provide valuable insights into potential trading opportunities. Section 6. Identifying and trading failure swings. Identifying and trading failure swings can be highly profitable for traders who understand the underlying concepts. By recognizing these patterns, traders can capitalize on potential trend reversals or corrections. To identify a failure swing, look for the following characteristics: failure to create a new swing high in an uptrend or a new swing low in a downtrend, break of the previous swing low in an uptrend or swing high in a downtrend, and confirmation from other technical indicators such as candlestick patterns or momentum oscillators. Once a failure swing is identified, traders can consider entering trades in the direction of the anticipated reversal or correction. For example, in an uptrend, if a failure swing occurs, traders might consider taking their profits. It's important to note that failure swings don't always guarantee a trend reversal. The market can be unpredictable and false signals can occur. Therefore, traders should always use stop-loss orders to manage their risk and protect their capital. Section 7. Practical examples of trading with failure swings. Let's illustrate the concept of trading with failure swings using practical examples. Example 1. Long trade setup in an uptrend. The price is in an uptrend, making higher highs and higher lows. The price attempts to make a new swing high but fails and starts to reverse. The price breaks below the previous swing low, confirming a failure swing. Traders could consider taking profits below the previous swing. Example 2. Long trade set up in a downtrend. The price is in a downtrend, making lower lows and lower highs. The price attempts to make a new swing low but fails and starts to reverse. The price breaks above the previous swing high, confirming a failure swing. Traders could consider entering long positions above the previous swing high with a stop-loss order below the recent swing low. Remember, these are just examples, and traders should always conduct their own analysis and consider multiple factors before making any trading decisions. Section 8. Conclusion. Navigating the markets with swing highs, lows, and failure swings. Mastering the concepts of swing highs, swing lows, and failure swings is crucial for traders seeking to navigate the complexities of the financial markets. These concepts provide a solid foundation for understanding market structure, identifying trends, and recognizing potential trading opportunities. By analyzing the patterns formed by swing highs and lows, traders can determine the direction and strength of the prevailing trend. Failure swings, on the other hand, alert traders to potential trend reversals or corrections, enabling them to adapt their strategies accordingly. However, it's essential to remember that technical analysis is not an exact science. False signals can occur and market conditions can change rapidly. Therefore, traders should always use risk management techniques such as stop-loss orders to protect their capital. Section 9. Final thoughts. The significance of market structure for informed trading decisions. In conclusion, a deep understanding of market structure is fundamental for any trader aiming to make informed decisions. Swing highs, swing lows, and failure swings are not merely patterns on a chart. They represent shifts in supply and demand, reflecting the sentiment and actions of market participants. By recognizing these patterns, traders gain valuable insights into the potential direction of the market. They can identify trends, anticipate reversals, and pinpoint opportune moments to enter or exit trades. This understanding empowers traders to navigate the complexities of the market with greater confidence and clarity. We will keep deep diving into important subjects. Don't forget to subscribe and like for more insights.